All right, let's dive right in. Today, we are unpacking a Nobel Prize-winning idea that literally changed the entire world of modern finance. It's called the Markowitz model, and it gives us a surprisingly elegant mathematical answer to one of the biggest questions in investing.
I mean, think about it. This is the question, right? Every single investor, whether you're just starting out or you're a pro on Wall Street, you face this exact problem. You've got some cash, you want to put it to work, but how in the world do you mix and match different assets, stocks, bonds, whatever, to create that perfect combination?
Well, back in 1952, an economist named Harry Markowitz came along and pretty much gave us the answer. Before him, picking stocks was, it was more of an art form, a gut feeling. Markowitz, he turned it into a science, giving us a clear mathematical framework for making the smartest choices possible.
So, how'd he do it? What was the big insight? Well, Markowitz figured out that this whole super complicated decision about what to invest in, it really just boils down to a trade-off between two things. Just two.
And here they are. On one side, you have what you want, expected return. That's the good stuff, the average profit you're hoping to make. And on the other side, you've got what you fear, risk. That's the scary part, the volatility, how wildly your investment could swing up and down. His entire model is basically a balancing act between these two powerful forces.
So let's start with the fun part, right? Figuring out your potential return. Now, you might be thinking this involves some crazy, complex financial math, but honestly, it's the most straightforward piece of this entire puzzle.
See, the expected return of your whole portfolio is just the weighted average of the returns of every single thing in it. All that really means is you take the expected return for each stock, you multiply it by how much of your portfolio it takes up, and then you just add them all together.
For instance, look at this. If you split your money 50-50 between stock A, which you think will return 8%, and stock B, which you expect to return 12%, your portfolio's expected return is just the simple average, 10%. See? Easy.
Okay, so calculating returns, that's a piece of cake. But measuring risk? That is where Markowitz's real genius kicks in. This is the secret sauce of what we now call modern portfolio theory.
Now, before Markowitz, pretty much everyone just assumed that the risk of your whole portfolio was, the average risk of all the stocks inside it. Makes sense, right? But he proved that's totally wrong. The really crucial thing isn't about how risky each stock is on its own. It's about how their prices move in relation to each other.
Whoa, okay, don't let the formula scare you. It's actually pretty simple. The first two chunks are just the individual risks of your stocks. But the game-changing part, the really revolutionary piece, is that last term, the covariance. That measures how two assets move together. And what it shows brilliantly is that if you combine assets that don't move in perfect sync, you can actually lower the total risk of your portfolio. That's the magic of diversification, right there in the math.
Okay, so now we have a way to calculate return and a much smarter way to measure risk. So let's put them together and see how they create a kind of map for finding the absolute best portfolios out of all the infinite possibilities.
And this map has a name. It's called the efficient frontier. Basically, it's a curve that plots out every single one of the best possible portfolios you could build. You can think of it as a collection of all the best-in-class options.
So what's this curve actually telling us? It says that for any level of risk you're willing to take on, there is one and only one portfolio that gives you the absolute highest possible return. Any portfolio that falls below that curve is inefficient. You're taking on risk and not getting the best reward for it. So your job as an investor is to find the one perfect spot on that curve that feels right for you.
This all sounds fantastic in a university classroom, but let's get real. How does an everyday investor actually use this powerful idea to make decisions in the real world with real money?
This quote here really nails it. The practical goal, the whole point, is to use this model to find the portfolio that gives you the most bang for your buck based on how much risk, how much volatility you can personally handle. But there's a catch, and it's a big one. To actually find this efficient frontier, you have to do some seriously heavy-duty math, solving what's called a quadratic optimization problem. And remember, the inputs you're using are usually based on past performance, which is never a guarantee of the future. Honestly, for more than just a couple of stocks, doing this by hand is practically impossible.
And that, my friends, is where modern technology is a total game changer. Today, you don't need to be a math genius.
Apps and software like the Stocks 2Buy tool mentioned in the source material, they do all the hard work for you. You just plug in the assets you're interested in, the app runs all the complex calculations, and then it just shows you a set of optimal portfolios right there on the efficient frontier. All you have to do is pick the one that matches your personal comfort level with risk.
So here's the bottom line. What was once a super complex, revolutionary theory for academics is now a practical tool that pretty much anyone can use. Technology has taken this Nobel Prize-winning mathematics and put it right in the palm of your hand.
And that kind of leaves us with one final thought to chew on. Using these tools, you can build a portfolio that is mathematically perfect for you right now, today. But investing is never a one-and-done deal. As your life changes, your goals, your timeline, your stomach for risk, your perfect spot on that efficient frontier might need to change too. Just something to think about.